Silver versus gold is once again becoming one of the most important conversations in the American investment landscape as 2026 approaches, not because investors are chasing excitement, but because capital preservation, purchasing power, and long-term value are becoming central concerns in a slowing global economy, where inflation has cooled but not disappeared. Interest rates remain sensitive, and geopolitical uncertainty continues to shape financial decisions across households, institutions, and long-term portfolios. And when investors look at precious metals in this environment, they are not asking which asset will make them rich overnight. They are asking which metal better protects value, offers flexibility, and aligns with real economic use cases. Gold enters 2026 with a reputation built over centuries, functioning as a monetary asset, a reserve hedge, and a stability anchor for central banks, governments, and conservative investors. And in the United States, gold remains deeply tied to long-term wealth preservation strategies, retirement diversification, and protection against currency erosion. Not because gold produces income, but because it historically holds purchasing power when confidence in paper assets weakens. And this role becomes even more relevant when investors are navigating uncertain policy cycles, fiscal deficits, and shifting global alliances. Silver, on the other hand, walks into 2026 carrying a dual identity that gold does not have. Because silver is not only a monetary metal, but also a critical industrial input deeply embedded in modern technology. Clean energy systems, medical equipment, electronics, and infrastructure development. And this dual demand structure changes how silver behaves in economic cycles, because its price is influenced not only by investor sentiment, but also by real physical consumption, manufacturing growth, and technological expansion within the American economy and beyond. When comparing silver and gold for 2026, the first major distinction investors must understand is volatility, because silver historically moves faster and more aggressively than gold, both upward and downward. Meaning silver often delivers stronger percentage moves during growth phases, but also experiences sharper pullbacks during slowdowns, while gold tends to move with more stability, responding primarily to macroeconomic shifts like interest rate expectations, inflation outlooks, and currency strength rather than industrial demand cycles. From a valuation standpoint, silver remains significantly more affordable per ounce than gold, which psychologically and practically matters for retail investors in the United States who want physical exposure or smaller position sizing. Because silver allows gradual accumulation without requiring large capital commitments, while gold often represents a higher entry barrier for direct ownership, especially for those building diversified portfolios step by step, rather than deploying lump sums. Another key difference heading into 2026 is supply dynamics, because gold mining output grows slowly and predictably, whereas silver supply is constrained by the fact that a large portion of global silver production comes as a byproduct of mining other metals, which limits the ability of producers to rapidly increase output even when demand rises. And this structural limitation means that sustained industrial growth can place long-term upward pressure on silver prices in ways that gold does not experience to the same degree. From an institutional perspective, gold continues to dominate reserve holdings, exchange-traded funds, and long-term asset allocation models because it offers stability, liquidity, and global acceptance as a store of value, while silver is increasingly being viewed as a strategic growth metal tied to energy transitions, infrastructure upgrades, and technological investment cycles that are expected to continue through the second half of the decade, particularly in North America. Risk management is another important lens through which silver and gold must be evaluated for 2026, because gold historically performs well during economic stress, recession fears, and monetary easing cycles, acting as a defensive asset, while silver performs best when economic activity stabilizes or expands, benefiting from increased production, innovation, and industrial demand, meaning the two metals serve different but complementary roles, rather than functioning as direct substitutes. For American investors building long-term portfolios, the decision is not necessarily about choosing silver or gold exclusively, but about understanding allocation purpose. Because gold serves as insurance against systemic risk, currency weakness, and long-term purchasing power erosion, while silver offers exposure to economic growth, technological demand, and potentially higher upside when conditions align. And this distinction becomes crucial when structuring portfolios for resilience rather than speculation. In 2026, policy expectations also play a critical role, because interest rate stability or gradual easing tends to support both metals. But gold reacts more directly to real yield movements, while silver responds more strongly to manufacturing activity, infrastructure spending, and clean energy investment trends, all of which remain active policy priorities within the United States. Liquidity behavior further separates the two, because gold markets are deeper and more stable, allowing large institutions to enter and exit positions with minimal disruption, while silver markets are smaller and more sensitive to shifts in demand, which can amplify price movements and create periods of rapid appreciation or correction, depending on market conditions. For long-term investors focused on capital preservation with minimal volatility, gold maintains a clear advantage going into 2026. While for investors willing to tolerate price swings in exchange for potential growth tied to real economic use, silver presents a compelling case, especially as technological adoption and infrastructure investment remain structural themes rather than short-term trends. As we move deeper into 2026, understanding these differences becomes essential, because the question is not which metal is better in isolation, but which metal aligns with the investor's objective, time horizon, and risk tolerance. And in the next part, we will examine performance scenarios, allocation strategies, and practical decision frameworks that help investors determine how silver and gold may behave under different economic outcomes. As 2026 continues to unfold, the real question for American investors is no longer whether silver or gold has value, but under which economic conditions each metal performs best, and how realistic scenarios may shape outcomes, because markets do not move in straight lines, and precious metals respond differently depending on growth, inflation, monetary policy, and confidence levels, making scenario-based thinking far more useful than fixed predictions. In a scenario where the United States experiences moderate economic growth with controlled inflation, stable employment, and steady consumer demand, silver tends to gain an advantage because industrial activity expands alongside infrastructure spending, clean energy deployment, and technology manufacturing, all of which rely on silver as a core material, meaning demand increases organically rather than through fear-driven buying, while gold in this environment often remains stable but less aggressive, functioning more as a portfolio anchor than a growth driver. If the economy enters a slowdown without severe contraction, where growth softens but financial systems remain intact, silver can still perform well if industrial demand remains resilient, particularly in sectors supported by long-term government initiatives, while gold begins to attract more defensive interest as investors rebalance toward stability, resulting in both metals appreciating but for different reasons, with silver driven by usage and gold driven by caution. In a recessionary scenario where consumer confidence weakens, manufacturing slows, and risk assets lose momentum, gold historically takes the lead because its value proposition does not rely on industrial output, but rather on trust scarcity and global acceptance as a store of value, while silver may experience short-term pressure due to reduced industrial demand, even though its long-term fundamentals remain intact, highlighting the importance of time horizon when evaluating performance. Inflation dynamics also shape outcomes, because during periods of persistent inflation, where purchasing power erodes gradually, both metals offer protection, but gold responds more directly to inflation expectations and real interest rates, while silver benefits when inflation coincides with economic expansion rather than contraction, making silver more sensitive to the quality of growth, rather than inflation alone. Interest rate policy further influences which metal gains an edge, because declining or stable rates generally support precious metals by reducing opportunity cost. But gold tends to react more predictably to rate signals, while silver's reaction depends on whether rate changes stimulate or suppress economic activity, meaning silver can outperform when rate policy encourages investment and production, rather than simply signaling fear. From a portfolio construction standpoint, gold is often treated as a core holding, rather than a tactical trade, because its role is protection rather than performance chasing, while silver is better positioned as a strategic satellite asset, offering growth potential tied to real-world demand. Meaning allocations should reflect purpose, rather than short-term price expectations. For investors with long-term horizons, combining both metals creates balance because gold dampens volatility and preserves capital during stress periods, while silver introduces upside potential during expansion phases, allowing portfolios to adapt across cycles without relying on market timing, which is notoriously difficult even for professionals. Another factor shaping 2026 outcomes is supply discipline because gold supply grows slowly and predictably, reinforcing its scarcity narrative, while silver supply faces structural limitations due to its byproduct nature, which can create tight conditions when demand rises, unexpectedly amplifying price movements and increasing silver MBOS sensitivity to global production trends. Currency dynamics also matter because a weaker dollar generally supports both metals. But gold often attracts international capital flows more consistently, while silver benefits when domestic manufacturing and infrastructure spending expand, reinforcing its connection to national economic policy rather than purely global monetary trends. Investor psychology further separates the two, because gold is widely viewed as protection, attracting capital during uncertainty, while silver often attracts attention after momentum builds, meaning silver rallies can accelerate quickly once confidence returns, but also correct faster when sentiment shifts, reinforcing the need for disciplined positioning rather than emotional reactions. Liquidity considerations play a role as well, because gold markets offer deep liquidity, reducing execution risk for large allocations, while silver's smaller market size increases sensitivity to demand shifts, which can benefit patient investors but challenge those seeking short-term stability, especially during volatile periods. Tax treatment, storage considerations, and transaction costs also influence decisions, because gold's higher value density makes storage and transport more efficient, while silver requires more space and handling for equivalent value, making physical ownership considerations part of the decision framework rather than an afterthought. Ultimately, asking which precious metal wins in 2026 oversimplifies a complex decision, because the real winner depends on economic trajectory, risk tolerance, and portfolio objectives, not headlines or short-term price movements. And investors who approach silver and gold with clarity rather than comparison tend to make more consistent decisions. Gold wins when protection, stability, and preservation are the priority, especially during uncertainty or monetary stress, while silver wins when growth, innovation, and industrial expansion drive demand, offering higher upside potential alongside greater volatility, making both metals relevant rather than redundant. The most effective strategy for 2026 is not choosing sides, but understanding roles, allowing gold to anchor portfolios and silver to enhance growth exposure, creating balance that aligns with real economic forces rather than speculation. And for investors who respect this distinction, precious metals become tools of discipline rather than emotion. In the end, silver and gold are not competitors, but complements, each responding to different signals, serving different purposes, and rewarding different types of patience. And in a world shaped by uncertainty and transformation, understanding how and when each metal shines may matter more than predicting which one outperforms on paper.